Hello everyone, welcome to today's webinar, Property Tax Changes. I'd like to introduce today's presenter, Grant Neagle. He's a Director of Ingamora. Welcome, Grant.
Welcome everybody, welcome to our property tax update. It's actually nice to be standing here and presenting on something positive in terms of the tax changes. The current coalition government is largely unwound or wound back some of the tax policy settings to what they were prior to the previous government. So look, that's positive. I think we've only got one negative or slightly negative thing to cover, and we'll say that for the end, and we won't dwell on it too long. So without further ado, again, welcome, and we'll get straight into the presentation. All right, what are we going to be covering today? Just go through the quick agenda. Firstly, 2-year Brightline rule and main home exemption. So some of you might remember the original 2-year Brightline rule before it was changed on multiple occasions. Then the interest limitation rule, so interest on debt to be 100% deductible for tax. Relief from Brightline tax when transferring property, particularly property transferred between associates or related parties, colloquially known as rollover relief. Then we'll take a look at refinancing opportunities. Commercial properties, 0% depreciation, and that's the slightly negative news. And if we've got some time at the end, I'll cover some questions that you might have. Two-year Brightline rule. Very much a case of back to the future. For those of you not familiar with the Brightline rule, it's a tax rule that taxes property if it's bought and sold within a particular time frame. Historically, there has been no Brightline rule. Then National kicked it off a number of years ago with a 2-year rule. It was then increased to 5 years and then to 10 years under the Labor government. So we've got it back again. So the policy setting's been unwound, back to the 2-year Brightline. Now that relates to properties that are sold after 1 July this year. So properties sold before 1 July, the old Brightline rules, the 5, the 10-year, the 5-year for new builds as defined, still apply. So positive going forward, property sold after 1 July 2024, subject now to only a 2-year Brightline. No new build distinction, all properties subject to the same 2-year rule. A new build distinction was a concession that the past government gave to encourage taxpayers to build new properties. So new builds were subject to only a 5-year Brightline. But now, no distinction. All properties are treated similarly. Now, it's worth mentioning that properties acquired with the purpose or intention of sale or disposal still taxed regardless of time frame. So they're outside the Brightline rules. Now, this rule has always applied. So look, if you're buying a property to flip, and at the time you acquired it, you had an intention to sell it and dispose of it, well, then it'll be taxed. So the Brightline rule's very much a shield, if you like, but they're not a sword. So that's something just to be aware of. So what is the Brightline period? We talk about properties bought and sold within a period, but for tax, there are some rules around when a property is deemed to be acquired and when it's deemed to be sold. So these rules are important to understand, particularly if you're buying and selling a property and it's running close to the 2-year Brightline timeframe. So In front of you on the slide is a continuum from when a property on the far left. So you enter into a contract to purchase a property, and you sign that agreement. That's not the start of the Brightline period if you're the purchaser. The start of the Brightline period, or when the 2-year period starts, is the date of registration of that property with Land Information New Zealand. When you come to sell the property, the date you enter into a binding sale and purchase agreement to sell the property, that's the end date or the disposal date for that Brightline period. It's not the date that the property is settled or the property title is updated with Land Information New Zealand. So this is for a standard property purchase. There are some exceptions to this, but generally this applies for most vanilla property purchases. So really, as you can see there, the government has stacked the cards in their favour. So they delay the start of the acquisition period as long as possible and bring the end date, or the disposal date, forward as much as possible. So the period of ownership for the Brightline purposes is as short as it can be. So it's that little green bit in the middle. If you look at over the whole continuum, it's relatively short. So it's good to bear in mind. Just a practical example to illustrate where a property was acquired before the rule change, effective 1 July 2024, but sold after the rule change. So in this example here, look at the far left of that continuum, 15th of April 2022, a purchaser signed a binding sale and purchase agreement. The property settled and the title was registered with LINZ on the 31st of July 2022. That kicked off the start period for the Brightline. The new rule obviously came in 1 July 2024, such that properties sold or disposed of after 1 July 2024, only a 2-year Brightline applied. The owner then entered into a contract to sell the property on the 31st of August 2024. So they signed an agreement. It was a binding sale and purchase agreement. And then the property settled and title was transferred on the 30th of September. So the Brightline period in respect of that transaction is the period between 31 July 2022 and 31 August 2024. So it's 2 years and 1 month, essentially. So the sale, because the Brightline period is greater than 2 years, that property would not be subject to tax. Now just moving on to the main home exclusion. So not all transactions are subject to the Brightline rule. There are some exceptions. One particular exception is the main home exemption. So a little bit of history on this. The old rules, it used to be 50%, provided it was your main home for more than 50% of the Brightline period, then the Brightline rules wouldn't apply to tax it if it was disposed of. The Labor government then changed it to having to need to be your home for 100% of the time. There was a grace period of up to 12 months where if it was not used as a main home, that was fine. You know, a period between, for example, moving out of a property when it was sold. Now it's back to the main home for needing to be the main home for more than 50% of the Brightline period. And that relates to properties sold after 1 July 2024. Now, there's still the requirement that 50% or more of the property's area must have been used as the main home. So there's no change. That hasn't changed. So in certain instances, a taxpayer may have to consider the area of their property, particularly if the property has their home on it, but also an income earning activity as well, where the whole property isn't their home. It's only possible to have one main home at a particular time. So if you've got a home you live in town and you've got a holiday place which you're very familiar with and you spend a lot of time there as well, you can't argue that that's your home as well. So you can only have one main home, and that's the home you've got the closest connection to. However, you can apply the main home exclusion or exemption to potentially 2 or possibly more properties. that both have been the main home for more than 50% of the Brightline periods. For example, you could have had a property that was your main home. You may have moved out of that property but still retained it into a new home, and you might end up selling both, provided that those properties have been your main home for more than 50% of the time of ownership. Well, then the Brightline exclusion could apply. There is exclusion for main home held in a trust. So if the main home if it's main home of a beneficiary of the trust, and the principal settler of that trust does not have a main home, or it's a settler's main home that's been sold, well then that can be exempt as well. So homes in a trust can potentially be exempt from the Brightline rules. And just a cautionary note there, so the exclusion won't apply where it has been used twice in a 2-year period immediately before the sale. So that just stops repetitive buying and selling of main homes as a mechanism to get around the rules. There are other exclusions for farmland and business premises as well. So those rules haven't changed. So I won't cover those now, but just be aware that if you've got a property or a lifestyle block, or a property is being used as a business premises, either by yourself or perhaps by a tenant, that the Brightline rules may not apply to tax that property if it's disposed of. Now, coming on to the interest limitation rules. So previous government introduced rules that reduced the interest on funds borrowed that could be written off for tax purposes. These were known as the interest limitation rules. So, interest used to be 100% deductible on funds borrowed, and it was changed to 100% for new build properties. It was phased out slowly for other properties acquired before 27th of March 2021, or disallowed altogether. And that was mainly properties that were acquired or new debt drawn down post 27th of March 2021. So a real mismatch of the rules there. So it's simple going forward. So from 1 April 2024, you can claim 80% of the interest for funds borrowed for residential property, and that's regardless of when the property was acquired or the loan was drawn down. So that's positive. The current government would have liked it to be 100% for the 2024 year, the 2025 financial year that we're in now, but couldn't afford it. So from 1 April 2025, so from the start of the next financial year, interest deductibility would be fully restored and 100% could be claimed. Historic exclusions still apply from this. So certain companies in foreign residential property aren't or have never been restricted by these rules. Right, just moving on to the transfer of property between related parties, associated parties, known as rollover relief, tax speak. So when the rules were originally introduced back in 2015, there was no ability to transfer between associated parties without Brightline rules applying to tax the transaction. So from 1 April 2022, however, there were rules introduced that allowed in certain transactions the Brightline rules not to apply where that property was transferred, but in certain circumstances. How the rules worked is that if rollover applied, the concession applied, it did not trigger the Brightline rules. The transferee was deemed to have acquired the property at the transferor's acquisition date and price. Because they were acquiring it at the same price as the transferor had acquired it, there was no profit on the sale. That's how tax on any transaction was avoided. The old rules were narrow and complex. New rules now apply from 1 July 2024. So transfers are now allowed between entities, persons who are associated for tax purposes, provided they have been associated for at least 2 years prior to the transfer date. So this rule, the new rules, are more flexible and allow for a broader range of transactions and transfers. So what does it mean to be associated? Well, for tax purposes, parties can be associated in a whole lot of different ways. The rules are very comprehensive. and they're mainly there to catch nefarious transactions, but look, they're there also in a positive sense as well, particularly for these rules. So 2 relatives within 2 degrees of blood relationship are deemed to be associated. So if you transfer property between relatives, the concession could apply, rollover relief could apply, such that the Brightline rules don't apply. 2 persons who are married in a civil union or de facto relationship, they're associated. A company and a person other than a company, where that person owns 25% or more of that company, that's deemed to be associated. So if I've got 30% shares in a company, well, then I'm associated with that company. 2 companies where there's at least 50% common ownership. So where a single owner owns more than 50% of both those companies, a partner in a partnership, and the list goes on. A trusted, a beneficiary, settler, person with a power of appointment, 2 trusts. Look, and this is not an exhaustive list either. So, as you can see, there is potential to transfer property between a number of different persons and entities without being subject to the Brightline rules. And so this is just an example showing 2 degrees of relationship for relatives. So, if you're in the middle, the little blue person, and your spouse is as well, this shows all the people that you're deemed to be associated with for tax purposes. People within 2 degrees of relationship. So obviously you're associated with your parents and your spouse's parents and your grandparents and your spouse's grandparents, your siblings, your children, your spouse's children. So it is fairly broad. So these rules really are welcomed. Now, a little bit of a catch. It's only transfers between associates where they have been associated for at least 2 years prior to the transfer date. So really it restricts transfers to entities that are existing now. So, if you were to go and set up a new company or for something and immediately transfer a property into it, well, then the rollover relief rules wouldn't apply. And that's because that company hadn't been associated with you, the transferor rather, for 2 years prior to the transfer. Now, that doesn't necessarily apply where a new trust is established. Provided the beneficiaries of that new trust have been associated with you as a transferor or the entity transferring for at least 2 years, well, then the relief can apply. So in this instance, you can have a new trust. For example, with a trust resettlement, if you've got a trust and you want to get rid of that trust and you want to resettle onto a new trust for whatever reason, that will qualify for rollover relief, provided the beneficiaries of the new trust were beneficiaries of the old trust, i.e. the beneficiaries are both the same. So there are instances where you can have a new entity, but that entity can only be a trust. Now, the main home exemption, so any period of time a property has been a main home of the transferor, well, then that period of ownership is also attributed to the transferee and taken into account when the transferee sells the property. So that's advantageous as well. And transfers of deceased estates and relationship property transfers and agreements continue to provide rollover relief, as they always have. So there's nothing new there. Moving on, refinancing opportunities. So in order to take advantage of tax deductions for interest on debt that's borrowed to fund the purchase of a rental property, a common means to optimize this was to restructure the existing ownership of a property. Just an example here. So, and this is, for example, if a person's had a debt-free home they wanted to keep and apply for rental purposes, a common structure was for them to sell the property to another entity. And this is an example here. So we've got Phil and Sharon, and they've owned their home, their family home, since 2015. It's now freehold. It's valued at $900,000. They want to buy a new home worth $1.3 million and keep their old home as a rental property. They need to borrow $900,000 to fund the purchase of the new home. They will rent out the old house for $700 a week, which is about $36,000 a year. The holding costs, rates, insurance, maintenance expected to be about $7,000 per year. So Phil and Sharon estimate a rental profit of about $29,000 per annum. Phil's tax rate. He's on the highest tax rate, 39%. His share of that $29,000 profit per year, that is 14,500. So tax on that at his high marginal tax rate, 39%, is $5,655. Sharon's 50% share is taxed at her marginal rate, which is 33%. So between them, there's just over $10,000 of tax that they have to pay. And they'll be paying interest at 6%, for example, on $900K private loan to fund their new properties, which is about $54,000. So not the best outcome. So what historically we used to do is the individual, in this case Phil and Sharon, would sell their home to a look-through company or a company at its market value. The look-through company would borrow from a bank to purchase the house from the individuals. The individuals use the money to buy their new home. The LTC rents the property and claims tax deductions for the interest. Now, this really stopped when the government disallowed interest deductions and increased the Brightline to 5 and then 10 years. It sort of really put paid to that opportunity, made it very hard, and there was really no benefit for doing it if you couldn't get the interest deductible anyway. So with interest now deductible and a 2-year Brightline rule, also the favourable rollover relief concessions where you can transfer properties between related entities without actually triggering the Brightline. Restructuring opportunities like this are again a valid opportunity. So in this case, Phil and Sharon sell their home to a look-through company at $900,000. They make a capital gain on sale, but it's outside the Brightline period or the main home exception applies, so they're not taxed on that. The look-through company borrows $900,000 from the bank to purchase the property. The look-through company has a new 2-year Brightline clock, unless the rollover rules apply. So the new company might not have to reset that clock. It might only be a year to go, or 6 months in that period, or none at all. The look-through company gets 80% interest deductibility in 2024-25 year, and 100% deductibility or write-off in the 25-26 year. The look-through company will have rental losses of approximately $25,000 with 100% deductibility, that is. Now, the losses are what we call ring-fenced, so they can only be offset against future rental income derived from that property or within that company. So it's a good result for Phil and Sharon. Even with the ring-fencing, their LTC pays no tax compared to $10,500 they would have paid personally if they did not restructure. So, look, this is not tax avoidance if it's done properly, and then Revenue has confirmed this. It doesn't have to be a look-through company that purchases the property. It could be another entity. It could be a standard company. And it doesn't just have to be the family home that's transferred or sold into that company or other entity. It could be a sale of, for example, of an existing rental property. So with that, you see that there is the opportunity with the introduction or reintroduction of the interest deductibility rules and softening of the Brightline to take advantage of this within your current structures. Now, the negative news, not so good news, commercial buildings. So the coalition government announced the 0% depreciation rate for commercial buildings. So again, as with all the other tax changes, there is a history. Before the 2012 financial year, commercial buildings were depreciable. That rule was changed for income years between 2012 and 2020 by the national government to be not depreciable. Labor got in, and as part of some COVID economic policy responses to improve the productivity and sort of stimulate business activity, buildings began depreciable again between 2021 and 2024 financial years. And now, from 1 April 2024, no depreciation again. So commercial buildings are not depreciable. So for those of you who have commercial buildings, you'll know what they are. But for those that don't, commercial building is a building that is not a dwelling, a residential dwelling predominantly. And these rules always apply historically to a building or a structure that has an estimated use of 50 light years or more. So there are some commercial buildings that aren't deemed to have a 50 year or more commercial life. They can still be depreciable. They're quite limited though. Now, the buildings are still considered depreciable property, and it's just that a 0% depreciation rates apply. And the reason for that is because the government still wants them to be subject to the depreciation rules. For example, if a building is disposed of and historic depreciation has been claimed, well, then that depreciation could be clawed back and treated as income, for example, if that building is sold. And so the government still wanted those rules to apply. Now, when the rules were originally introduced back in FY 2012, for those people that had not split out, or those building owners that had not split out the fit out separately, they were allowed this notional fit out pool, which was 50% of the value of that commercial building, and they were able to depreciate it. Now, when Labor reintroduced the depreciation for the 2021 to 2024 years, that was gotten rid of because buildings became depreciable again. Now that they're not depreciable, that notional fit-out pool rule has been reinstated, such that if a owner has a property that was acquired before the 2012 year and hadn't been separately depreciating the fit-out, well, then they can reinstate or reapply that notional fit-out pool and depreciate it. Now, there's some rules around it, but certainly that's potentially favourable. For those that acquired commercial buildings between the 2021 and 2024 financial years, when the depreciation was restored, there's no assistance provided by the legislation. So for example, if a building had some fit out and it wasn't split out when that building was acquired and it was just depreciated along with the building at the building depreciation rate, well the only way to potentially split that out now and claim depreciation on that fit out separately is to apply to the IRD, to apply to the commissioner, and the commissioner can use their discretion as to whether or not they apply that. So that's really the only way to do it. Look, that's the end of the webinar. We'll receive a link to the webinar in the coming days. If you do have any more questions, please feel free to get in touch with us. So if you're an Ingham client, feel free to get in contact with your Ingham manager or your director. Look, if you're not an Ingham client and you have some questions or you want to know how we might be able to assist you or the services we offer, look, don't hesitate to get in contact with me. My details are there. Yes, thanks very much. Hopefully it's been informative for you. If you've got any suggestions or topics that you'd like to see covered in upcoming webinars, don't hesitate to send through some ideas. More than happy to cover those.
Great. Thank you, Grant. Thank you, everybody.